Hello everyone, and welcome to the third lesson of this workshop, where we will delve deep into the market structure. It will be fascinating because we have been sort of one-dimensional so far, mainly looking at price charts of specific futures contracts. But as we told you, there are many futures contracts for each commodity. Analyzing these contracts at once can reveal incredibly useful information about the market. But don't worry, it won't be complicated as we will use neat charts to simplify everything. And like in every lesson, I have to remind you, this video is not investment advice. If any financial instruments like futures, spreads, ETFs, options or other are mentioned anywhere in this video, it's always just for educational purposes. The previous lesson was pretty intensive and full of new information for most of you, so let's briefly summarize what we know. We know what commodities, how they are traded, what the futures contracts are, and various specifics of these contracts like an expiration date. We know that the price of the futures contract we can observe on the chart is not the same as the value of the contract. We know what the point value is, how it can help us calculate the expected profit or loss of some opportunity. We are also familiar with margin and leverage. Thanks to the margin account, we can trade huge futures contracts with relatively small capital. In the previous lesson, we promised to show you the software we use to display various charts and analyze them. This application is called Spreadcharts. Its founder and chief architect, Pavel Hala, is also the author of the strategies that we are going to teach you in the following lessons. You can find everything about it on spreadcharts.com, where you can also sign up. It has a free and premium version. You can sign up for the free version and follow all the charts we use in this and the following lessons. The premium version offers some advanced statistical studies and the ability to manage your own watchlist of charts you work with regularly. And to save you time looking for opportunities, it has signals generated by artificial intelligence that would alert you about potentially interesting market situations. And last but not least, there is premium research with video analysis of really the best opportunities. But for now, the free version would be sufficient for you. You can use it to check out the charts we will be talking about by yourself. There is also a comprehensive video tutorial on spreadcharts.com that will help you to learn using the app. We have been using just simple price charts so far. The horizontal axis of this chart shows time, usually a period of many weeks, months, or even years. The last data point in the chart is usually yesterday's price. The point is that it describes the past. The chart is even sometimes referred to as a historical price chart. But now we are going to show you a chart in which we are looking into the future. Here it is. It is called a term structure chart, and you can find it under this name in the Spreadcharts app. If you take a look at the horizontal axis on the bottom, it is also a timeline. But unlike the price chart, it shows future dates. This chart is from the beginning of 2020, but the horizontal axis has years like 2021, 22, and 23. In a sense, we are looking into the future here. These little dots connected by the lines are the futures contracts. We already know there are several futures contracts with different expiration dates for each commodity. And that is exactly what are you looking at in this chart right now. Specifically, these are corn futures contracts. The horizontal axis, or x-axis in other words, shows the expiration date. We are looking more and more into the future. The vertical axis, or y-axis, is the price, just as usual. So what does that mean? First of all, the more the dot or the futures contract is on the right side, the more in the future the expiration is. So the more into the future we are looking. And the second thing, the higher the dot, the more expensive the contract is. There are two more things to explain in this chart. The first one is the number above each futures contract, which stands for the current price of that futures contract. These prices are valid as of January 6th, 2020, which is the date in the bracket in the top left corner. It is, therefore, crucial to realize this chart shows the state of the market at some point in the time. Think about it as a market snapshot for some commodity, which is corn in this case. And in the small subchart below shows the open interest and volume. We don't want to delve into this too much at this point, but simply put, the higher these columns are, the more traded the contract is. This is also called liquidity. When some contract is traded a lot, we say it's very liquid. And you can notice that the more to the future we go on the chart, the less liquid the contracts are. The nearest contracts are usually the most liquid. Let's zoom the chart. Here you can see just a few nearest expirations, specifically the 5 nearest futures contracts. The first is the March contract. It means it expires in March, representing corn for delivery in March 2020 that currently costs 384.75 cents. It is, by the way, the most liquid contract as of January 6th. The next dot is the May expiration that trades for 391.5 cents per bushel. So this contract will expire and therefore cease to trade in May 2020. Before we continue, make sure you understand everything we have talked about so far. It is really important as we are going to build on these basics. If anything is unclear, just replay the video from the start. Otherwise, we can move on. Now, you are still looking at the corn term structure chart, but surely you noticed that the curve looks different. It is because this is a chart from June 2019. That's one of the great features of the spread charts application. You can plot these curves from the past and analyze historical events. But now, let's make up a story to better imagine the things we are going to talk about. Imagine that you are a farmer. You have many acres of land where you are growing corn. You have to plant it in the spring, then you have to take care so the corn would be of good quality, and finally you harvest it in autumn. That's how it goes in the northern hemisphere. Naturally, you will have a lot of corn after the harvest. You might not even sell it all immediately and decide to store some of it at the farm. Many farmers have these large silos, and those who don't can store the grain at their local elevator. This is not just convenience, but rather a necessity. Corn is needed continually, but the harvest is only once a year. Consequently, there is an overabundance of corn after the harvest, and it has to be stored somewhere. Logically, the prices are the lowest just after the harvest. Now, focus on these 4 circled dots on this term structure. These are September and December futures. You can clearly see these dots occupy the lowest place among other expirations. And that is precisely what I just said. Grain silos get full after the harvest in autumn. There is plenty of corn everywhere, which drives the price down. So everybody rightfully expects that corn with delivery at the end of the autumn or at the beginning of the winter will be the cheapest one. That's why these autumn futures expiration and especially the December contract are so low. Conversely, we expect the lowest supply just before the harvest. The inventories are gradually depleted and their level is obviously lowest before the harvest. Therefore, July expiration commands the highest price as it is the last contract before the harvest that usually starts in September. That is the reason why we, as farmers, can sell the corn for a higher price in July. And that's exactly what you see in this chart. These green circles highlight the July contracts across different expiration years. They are positioned above all the other contracts within a given year. So, when you are looking at this chart, you see the market's expectations at a specific date. This date is printed in the left top corner. But of course, the expectations can change over time due to weather, for example. And just take a look back at the situation in spring 2019. The weather conditions were pretty unfavorable for corn planting, and the market was worried if there will be enough corn in the autumn. As the expectations change, the shape of the term structure curve changes too. Supply and demand meet each other on the market every day. These changes impact not just the price of corn for immediate delivery, but also the contracts with delivery well in the future. We have been looking at the term structure from June 2019. For example, here is the corn term structure we saw in September 2019. Can you see that massive change? And then January 2020. You already saw this one in this lesson. Again, a huge difference from September 2019. If this caught your interest, you can open the Spreadcharts app and browse term structure charts across history. Maybe you have noticed that the curve has a rising slope somewhere and a falling slope somewhere else. That is another important thing you are going to learn in this lesson. First of all, let's focus on the part of the term structure where the curve is rising. This is called contango. It means that the more distant contracts are more expensive than near contracts on the segment of term structure we are looking at. Contango is the normal state of the market. And why? The most important factor is the storage cost. Corn is a good example. As we said, the new supply comes to market only once a year. Let's say someone needs corn, but not immediately. He wants to arrange delivery 6 months after harvest and fix the future price now. Imagine that you are a farmer with silos full of corn and would be willing to deliver that corn in 6 months. But as no new corn will be harvested till then, you have to store the corn until the date, which means additional cost for you. So you say, all right, I will deliver the corn in 6 months, but you have to pay for these costs. If you want the corn in 3 months, my cost will be lower, so your price would be lower too. And if you want the corn immediately, there are no storage costs, so the price would be the lowest. The higher costs are related to physical storage of the commodity, insurance, financing, etc. And why should someone want to buy a commodity so much in advance? You can see the answer in this slide. The goal is to hedge the future price now. Let's demonstrate it again on an example that you can easily understand. Imagine a cornflake producer and a corn grower. Logically, the producer needs corn to produce cornflakes. For some reason, the producer thinks the price of the corn will be much higher in half a year. So he decides to buy a futures contract with an expiration date in 6 months. The producer does not need the corn right now as he has enough corn inventories for the upcoming 6 months. All he needs is to hedge the price for which he will get the corn in half a year. The counterparty to this contract is a corn grower who sells a futures contract on the exchange. As there will not be a harvest in 6 months, he has to fulfill the order from his inventories. In other words, he has to store the corn and deliver it in 6 months. Of course, this is associated with storage costs. Naturally, he includes these costs in the price of the contract. The cornflakes producer doesn't mind these additional costs, because if he buys the corn immediately at the current price, he would have to store it himself for 6 months. In the end, he would pay similar fees for this storage, and the final price would be the same as the price of the futures contract. The point is that the storage cost cannot just disappear from the market. It must be included in the price of futures contracts. And logically, the longer something is stored, the higher the cost and the higher the price of more distant futures contracts. We've just talked about contango. The opposite state of the market is called backwardation. You are looking at the term structure of cocoa and notice that the curve is downward sloping. Backwardation simply means the nearer futures trade at a higher price than more distant futures. And when does this happen? Such a situation is usually associated with some extraordinary market conditions. It can be a sudden spike in demand, but more often it's a supply side problem. For example, extremely dry weather damages the corn crop. The market starts to fear there will be not enough corn to meet demand. In effect, traders start buying the corn for immediate delivery and store it. Their goal is to secure the supply of the physical commodity despite the high price. That is why the near futures are much more sensitive to these situations than the more distant futures contracts. The downward slope is greatest at the beginning, as the first few months are the most expensive ones. If you are a cornflakes producing company, you need the corn no matter the cost. On the contrary, the price of the farther contracts is not so extreme and is falling with increasing time to expiration. Given enough time, the market can adapt to the new situation. For example, the corn crop will be small this year and the prices are sky high. But farmers obviously see this and plant more acres of corn next year, as it is more profitable than soybeans. That will lead to a larger corn crop next year, sending the price lower eventually. Every trader knows this and anticipates this. Therefore, more distant futures are not so expensive. Given enough time, the market can adapt. You might wonder why the entire term structure curve is not in contango or backwardation. Why do some parts of the curve remain in the opposite state? Take the corn term structure chart, for example. There is contango everywhere except the part of the curve between July and December. Actually, this is caused by a different phenomenon that we already mentioned before. It is the effect of harvest that happens every autumn. It brings new supply to the market and kind of resets the curve. The contracts from December up to July next year fall into the same crop. If you think about it for a moment, you will realize these different crop years act like slightly different commodities. That's because the underlying for those very distant contracts is actually corn that is not even planted yet. The current weather has zero impact on it. On the other hand, after the harvest concludes and inventories are known, the underlying for the near contract is grain stored safely in silos. These truly feel like slightly different commodities. Maybe you wonder why we always speak about December and July as the important expirations and never mention September. The truth is, September is positioned too close to the harvest. It is usually considered part of the new crop, but some years may be exceptional if the harvest gets delayed due to weather. Traders consider September an odd expiration, and this contract has much lower liquidity than December and July. Maybe you wonder why I am talking about this in such detail. The reason is that it's essential. Every commodity trader must understand what the term structure chart is telling him. Let's demonstrate it on a practical example. Let's say we expect the corn price to rise for some reason. The best way to trade this opportunity would be to choose the July contract. Why? Simply because July expiration is the last contract of the old crop when the market is tight as inventories are thin before the harvest. Therefore, it is the most sensitive contract to changes in supply and demand. So when the corn price goes up, the July contract usually moves the most. Reading and understanding the term structure is also critical for commodity spreads, but this topic is for another lesson. Now, let's take a look at another commodity. Here is the term structure for lean hogs. Even if you don't know anything about that market, the term structure can reveal a lot about its production cycle. And we can use it to our advantage. You can see both backwardation and contango on the curve. Summer contracts are usually the most expensive. Hence, the inventories must be low in this period. On the contrary, the December contract is the cheapest one. The inventories must be high at the end of the year, which pushes the price down. Is this just a coincidence? Of course not. The slaughters reach the peak just before winter, which brings a lot of supply to the market. In fact, this is a similar effect to harvest in grains. Instead of crop seasons, we talk about slaughter seasons here. Once again, this is strategically useful. We would buy a summer contract if we expect hog prices to go up, as it is the most sensitive expiration to any supply or demand problems. It doesn't mean that these close expirations will not grow too. It's just that usually the summer contracts outperform the rest as the inventories tend to be thin in that period. I'm sure it's clear why the term structure chart is essential for every commodity trader. It provides a deeper insight into the market even without being an expert in agriculture. If commodities got your attention and you are thinking about getting into commodity trading, we must mention the advantages and disadvantages. I am sure this information will be valuable. Let's start with the advantages. There are plenty of commodities that you can trade, and many of these commodities do not correlate with each other too much. Of course, it does not apply to commodities in the same commodity group. For example, crude oil and gasoline prices usually move in a similar way. When we talk about grains, corn and soybeans also behave similarly, and it makes sense. They are usually grown in the same area, so they often compete for the same acreage. They can also substitute each other in some cases like feedstock. But commodity groups themselves do not correlate to each other too much. Take grains and metals, for example, and they have very little in common. And that is great advantage. Stocks or even stock indexes usually correlate heavily together. It requires a lot of expertise and research to build an uncorrelated stock portfolio. This is especially difficult when macroeconomic factors dominate the market. The whole stock market then moves in the same direction, no matter how successful individual companies are. This can be incredibly dangerous in recessions as it increases the overall risk of your portfolio. Imagine that you buy shares of a chemical plant and some internet company, seemingly two different companies from entirely different industries. But when the panic spreads in the market, the stock prices head south no matter what. In such dire times, any asset that at least partially compensates for these losses is precious. But it's next to impossible to find this diversifying element in the stock market. Any stock we buy just increases our overall risk during recession. But when you find that uncorrelated asset, you can enhance your profit potential without increasing the risk. Commodities can perform this role perfectly. Of course, not all commodities. During recessions, things like energy or industrial metals tend to tank with the stock market, but grains and soft commodities like cocoa or orange juice most likely will not care about the panic in the stock market. And safe havens like gold can even rise in some challenging economic conditions. Moreover, commodity trading can be profitable on its own. Commodities exhibit nice trends over periods of many years. Riding these trends can result in excellent profits with acceptable risk. However, everything has advantages but also disadvantages. There is no exception to this rule. Commodities have one major disadvantage. They are expensive. You can buy just one share of a company when it comes to stock trading, typically for tens or hundreds of dollars. That is affordable even for everyone. However, futures contracts are huge. Their value is usually in tens of thousands of dollars. And while margin limits the actual amount of capital we need, the risk associated with trading such expensive asset remains. In fact, commodity traders are rarely limited by margin requirements. It's usually the risk that restricts them. In other words, you need a large account to be able to handle this risk. We are talking about at least $50,000. And just to be clear, corn is not really an expensive commodity. For example, a gold futures contract has a value of well over $100,000, depending on price. Imagine its price moves just by a few percentage points. That's not dramatic at all. Such a move can even happen in a single day. Yet, the result is a change in the value of the contract by thousands of dollars. If you do not have a large enough account to handle this volatility, you would quickly go broke after a few bad trades. And keep in mind, we have been talking about trading just one contract so far. This is rarely the case in practice. Managing a position with just one contract is very restrictive. It is always better to trade at least 2 contracts so that we can enter and exit the trade gradually. Now, if you multiply the numbers in our previous example by 2 or 3, you will get account size beyond the reach of the majority of people. This often leads people to try so-called CFDs offered by forex brokers. There are numerous commercials on the internet and even on TV where these contracts are presented as commodities. However, we have to warn you, the CFDs are not real commodities. They are synthetic contracts, and when you trade CFDs, you are not trading on an exchange. In fact, you are often trading against your broker. It's like going to a casino. You can make some lucky bets, but the house never loses in the end. CFDs are unregulated instruments, and many CFD brokers are outright scams. Always trade with reputable brokers from developed countries like the USA or European Union with a strong rule of law. And remember that futures are the real commodities. These are well-regulated contracts, and even the futures brokers must pass strict requirements to be in the business. So, are there other options when you want to trade commodities with a smaller account? Well, there are. Maybe you heard about the so-called mini futures contracts. These are normal futures contracts, just with a smaller contract size. But in our opinion, they are not a solution. While these contracts are smaller, their size is still too large. They are usually half the size of normal contracts. Another disadvantage is lower liquidity. Especially large institutional traders have no reason to trade these mini contracts. Still, the liquidity on the front contracts on gold and crude oil is good. There are also many contracts for grains, but these are rather illiquid and not recommended to trade. A relatively new phenomenon is the micro contracts. The idea is the same as with mini contracts, just the size of these contracts is even smaller. It's usually 1/10 of the normal contracts. And it's fair to say these contracts are finally small enough even for people with small accounts. The problem is the selection of micro contracts is limited. The only liquid micro contracts at the time of making this lesson are gold and crude oil. There are no micrograins or agricultural commodities at all. On a positive note, gold and crude oil are popular commodities, so these 2 micro contracts can be suitable for beginners. But what if you want to trade agricultural commodities like grains or meats? Fortunately, there is a way to trade commodities with much lower risk and a much smaller account. The technique is called commodity spreads, which will be the topic of our future lessons. If you are interested in futures contracts but do not have a large enough account, don't worry. We are going to show you a strategy which can help a lot in this regard. Well, and this is the end of this lesson where we explained how the commodity market works in detail. Our next lesson will not be as complicated. We will talk about seasonality and technical analysis. These things are easy to understand, as you will see yourself. See you in the next lesson.